Hey guys, what's going on? Spencer Gray here from the Gray Report. We've got another great episode today. So if you're a multifamily investor, you're curious about multifamily investing, industry insider, like the idea of creating passive income, generational wealth by investing through multifamily apartments, well, this is the place to be because we're going to be going through everything that happened in the multifamily industry, the economy, real estate in general, all in one place. Doing kind of a recap of what we sent out in the Gray Report newsletter. Goes out every Thursday morning at 8:30. So a lot of stuff, crazy stuff going on. Eviction moratorium, it's ending. It's continuing. A lot of confusion. A lot of other crazy things going on in the market. So let's get into it. Okay, once again, bringing in Dr. Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. Matt, again, a little confusing week. We called last week on the Gray Report saying eviction moratorium is coming to an end July 31st, but we said, don't be surprised if they extend it again. Kick the can down the road. Let's not fix the problem. There's, close to $50 billion of rental assistance that's been allocated. Only 3% of that, $3 billion of that is actually getting out to renters. So there's this big issue. Why are we still having this moratorium? And we've also kind of been debunking that this whole eviction tsunami narrative is more or less kind of just a media narrative and political narrative rather than reality. So that was a big, feature on the Gray Report. But it all kind of ties into the housing crisis, housing affordability crisis that's been going on for a long time. Really over the past, since the mid, late 2000s, really kind of 2009, 2010, we just really stopped building enough homes. So Matt, bring us in. Housing affordability crisis. What do we do?
Yeah. Houses are expensive, and extending the eviction moratorium may not be the best way to keep prices low. And I think it's an easier argument to say, okay, you can't get kicked out of your home. That's easy for people to understand, but it takes a little bit longer to describe the kind of effects of the eviction moratorium on the rising home prices. So that may be part of the political calculation, but I also think it's going to be hard to get that rent money. It's been so hard to get the rental assistance to people that have qualified for the eviction moratorium and have not paid their rent that is still due. But that's all kind of the backdrop really for the elevated price of homes and housing that's really been people are talking about it a lot this week. I don't think that we're on the precipice of a crash. You can find articles that says that we're headed off a cliff, but I think that we should not expect that, nor should we really expect runaway price increases. There's been some reaction and some kind of it hasn't just gone up and up and up. There has been some reaction to the high prices with a slightly lower demand, at least in the single family space. That being said, investors and individuals are increasingly aware of the low supply and high demand of housing in the United States, and we can expect really higher rents and higher home prices for the foreseeable future. My pithy line here is it's a crisis, not a crash. And that still means there's a problem, and that still means that there's a lot of work to be done.
The people calling for a crash, the same people who've been calling for a crash for the past 10 years, same people who've been calling for, ultra hyperinflation. It's a broken clock, right? Twice a day, I guess. But it's affordability gap. It's huge. And there's this narrative, there's a lot of articles to your point of saying that, the housing market is like, it's cooling down. It's just like, it's ice cold right now because transaction activity is down. It's the levels are still crazy just because inventory is so low. Inventory is so low. There's a slight lull in the summer, and then to the point, a lot of people just say, "I don't want to participate in this madness. Like maybe I'll sell my house, but I don't want to be I don't want to get into a bidding war. Who wants to do that and running around?" And so we were seeing a lot of people deciding, "Hey, I'm just going to rent for a while." Again, now the calculus of what makes more financial sense, renting versus buying. A lot of people are saying, why am I going to overpay for a house when I can just rent, take that money, invest it in something else I'm going to be looking through the lens of an investor, not looking through the lens of, a homeowner. And I want to be in the right place for my kids and my family. That may or may not be a great reason to invest in that location, in that property. So we've had a housing crisis for a long time. It's one of the reasons why we really got into this space, investing in apartments, because if there's not capital allocated to housing, there's no more housing. And people don't realize how much housing goes offline because it gets old, because it's not renovated. So you need builders building new housing, and you need investors renovating and maintaining the housing stock. The government, they can't do it if they wanted to. They couldn't figure it out. They're not organized. It takes private capital and investors to get this done. So hopefully we can build, renovate, and this eviction moratorium really, again, it's going to make things more unaffordable, because there may be individuals that say, I don't want the government getting in the way of preventing all evictions, and I just don't want to participate in that. I've talked to a couple of investors who are like, yeah, this whole eviction moratorium thing is crazy. And now I have to say, like, well, it's not really affecting us that much, because we don't have this huge list of non-paying payers. Like, we just don't. It's maybe a percentage of bad debt and collections are a percentage more than they were pre-pandemic, but it's not like half our rent rolls are full of non-payers. So interesting. Okay, just real quick, we're not going to do a full snapshot of rates and markets, but just quick update on the 10-year Treasury yield. We're back down to 1.19%, very low levels. There's more talk of this slow growth. Also, what we talked about last week, because we are in this run up of prices, all these supply bottlenecks, but all of these longstanding trends of technological advances, an aging population, and developed economy, that's a recipe for slow growth. And I still haven't seen any reason why we wouldn't continue that trend of relative, linear, but relative slow growth that we saw over the past decade or so. Now we're gapping up, and that's where it's like, I think people think transitory inflation is you go up and you go down. It's the period of growth may look like that, but when you're actually looking at the nominal level, you're gapping up. We were here and now we're up here, and we don't come back down. It continues to rise. It's just not going to be growing at the same rate, because rental prices, wages, they're very sticky. They don't go back down very easily at all. So, okay, eviction moratorium, CDC, the Biden administration, they don't even know if it's legal or constitutional. Biden even said he said I don't know if the courts will uphold this.
Yeah,
but we're gonna do it. We're gonna do it anyway. So they're gonna try it, because it has been thrown out on a lot of case by case basis by the courts, and CDC announces limited target eviction moratorium until early October. So Matt and I were trying to figure this out, okay, so what exactly, because it's counties that are experiencing high levels of community transmission. Matt, what have you been able to parse in this? We've got the order.
Okay, well,
what does it mean? What can we do? And that's the thing, it's confusion. How are we supposed to function here?
So I have a take on it, and we covered the expiration of the eviction moratorium last week, and we notably noted the probability of its extension, almost as like a path of least, almost as like a path of least resistance for the government. The studies supporting its effectiveness in reducing COVID are inconclusive, and that's charitable in some cases. It does little to reduce the enormous housing demand more broadly, and it creates this looming debt burden that has not been meaningfully addressed through government policy. You've said that only $3 billion of the $50 billion has been has really been given to renters. So even as inefficiently as that process has been, it is still, I think, favorable really to an eviction moratorium. And it is a cliff of debt that is approaching, and I don't see an easy solution for this.
Wait, what's the cliff of death? Say that again.
Of debt. I'm sorry.
Debt. Cliff of debt for bad debt
renters,
or for rent.
So it's the renter, their unpaid rent. They can't get evicted, and if they don't pay rent, rent is still due. And so I'm not really sure what happens there at the end.
Well, and that's the big confusion. So again, there's billions of dollars of rental assistance available. Only $3 billion have come out, and so one of the a covered definition of a covered person here is an individual that has used best efforts to obtain all government assistance for rent or housing. Well, if the assistance isn't actually there, then just about everyone's going to qualify now. And then it's also if you've got an income of $200,000, if you're filing jointly, you could be making $197,000 a year as a couple, and you can try to get your best efforts, which whatever those are, but the assistance isn't there. And so you can make $197,000, make a half attempt to get rental assistance, and you get an excuse to not being evicted. And the problem is there's a lot of residents out there who think that means they don't have to pay and they're going to be let off the hook. And that's what's dangerous about this is that people who can pay are saying, they think it's like a, like forbearance where it's like, oh, sure. Yeah, I'll tack it on. No big deal. That's not the case here. So I'm really concerned about a lot of residents falling into debt, getting evicted, having an eviction on the record. Now that most landlords, though, it's like no one likes evictions. Evictions aren't good for anybody, and NMHC's put a lot of good stuff out about this. But no landlord wants to have a bunch of evictions, especially for a resident who's making their best efforts. Now, if residents like screw you, landlord, like want that person to probably leave. But it's just sowing confusion, and it's kicking the can down the road. And I think part of it is there would not have been an eviction tsunami. And I think that if it had ended and there wasn't an eviction tsunami, the narrative would have fallen flat on its face. And you said there was this problem. There's not an eviction tsunami, but now, like slow rolling it out, they can go back and say, see, we didn't have this eviction tsunami because we were very measured, because we did it in just county by county by looking at the science.
Oh yeah, that's another thing. The county by county. If you look at the map of so this is it, the CDC says it's limited. It is a limited extension only to those counties that have high COVID spread. And if you look at that map says that 90 or 80% of all the counties in America have high COVID spread. So it's most of America.
And let's look at that real quick. So so this is the map. And so there's no data. So what happens if there's no data? Because and I'm colorblind, Matt, so you'll have to tell me. But okay,
I'll tell you, it looks mostly red, and red's not, and red is the high. Yeah,
red is high, and so it just how are they defining it? So yeah, so it's pretty much. But it's funny because evictions have been going on in a lot of these places with the eviction moratorium going on. So there's a lot of red, which is not good for COVID. And they are watching this COVID tracker here. This is today, and look at this. So they've got this forecast, and it's pretty accelerated. It's still we're at levels that we were back in February. So it's definitely not good. Delta variant is definitely a serious thing. But I just don't think this is about COVID. I think this is about the economy in politics. So, and it's a big narrative, and it's unfortunate. So many things have to become so hyper
long, and the longer it goes, the harder it is going to be to solve, which is really maybe the worst element of this is kind of snowballing itself. Yeah.
So Matt, you said you were frustrated, you were mad because this article, CNN Business, Wall Street is buying up family homes. The rent checks are too juicy to ignore. Those homes aren't for families, or those homes aren't for Wall Street. Those are for families. What got you so riled up about this?
If it was only Wall Street that was making the market here, it'd be almost like the tulip craze. It's just purely speculative. It's not speculative. The value is based on housing demand, really. And it's interesting. There's a quote there that perfectly summarizes and kind of goes against the editorialized headline. And it says, "The argument that institutional investors are buying every single house out there is not accurate. This means that the impact that institutional activity is having on house prices is likely to be limited overall, although it could be more pronounced in certain parts of the country." I think there are many reasons not to be afraid of investors here. Home prices are rising, again, because of high housing demand, low housing supply.
Now, I guess the question is, because I think there's a little bit of truth in all of that. Yes, like they're not like absolutely moving the market. The demand is not coming from Blackstone. but
Yeah.
Blackstone is buying a lot of houses right now. It's
Mhm.
not lowering the prices of single family homes. It's definitely
Yeah.
putting more pressure on prices, but is, again, is this more of an attempt to find, boogeyman, and again, the rise of the corporate landlords. How
Yeah.
scary does that sound? And but if you look, that's Europe's already there. This is how
Mhm.
most of the world
Yeah.
is that housing prices, real assets become very expensive because of low interest rates, and just wealth creation. The prices rise. I mean, like if you go to like a Switzerland or many European countries, like sure, some people do still own like property, but most of like the houses and property in Europe are often owned by like banks and insurance companies or corporations that are rented out. And so, it's a whole continent of, renters. And that's really kind of the direction that the United States is going. This whole idea of the American dream being tied to buying a single family home, that's a relative new concept. That was created by, that's branding by the banks needing a product to sell to ordinary Americans. The single family home and the American dream is a product created by the banks. And so this whole idea of like they're taking our homes that are endowed to us by
Yeah.
George Washington and Thomas Jefferson and Alexander Hamilton of going out and buying a home. That's not they even took out life, liberty, and property. That was supposed to go in the Declaration of Independence, changed it to, life, liberty, pursuit of happiness, and
Yeah.
sometimes like I think property would make more sense and things would be a lot more clear. Um, and you can see that those two are related, but there's not saying in the right to buy a single family home in a subdivision one day in the future, so you can go into $300,000 in debt and make that your
Yeah.
largest investment that you're ever going to make. Can buying single family homes be an incredible way to build wealth over time? Yeah, middle class wealth, absolutely. It's worked for millions, hundreds of millions of Americans. But it's building middle class wealth. It's the largest investment. And again, we just talked about this. You're looking through a lens of the best place for your family to live. Does that necessarily line up with the best investment for you to make? Your largest investment is also going to happens to be where I want to live. If that's the
Yeah.
case, great. And it's happened many, many, many times. But to say that we all need to outlaw people, companies from buying homes, turning them to rentals, is making a lot of assumptions about the way people choose to live their life. And if someone to say that buying a home is good and renting is bad, that's just where they have the moral authority to make those definitive statements. They don't. So they just
That's
get off their
true.
high
Yeah.
horse.
Yeah.
So yeah.
Well, and
So
I,
you
yeah.
were Matt, you were upset about the article, and look what it did to me.
I apologize, but
No,
yeah,
it's all good.
I completely agree. That's a good point. There's nothing wrong with renting, and increasingly, millennials as a generation are kind of coming around, and they don't buy homes like baby boomers or Gen X. So it's not set in stone either.
No, I've talked to so many people who are like, man, I'm thinking about selling my house. I'll be sitting on, a couple hundred grand. I can rent. I can get the coolest rental with all the amenities that I want. I can enroll those proceeds into, whether it's investing in apartments, investing in real estate, investing in stock market, whatever you want, cryptocurrencies, whatever, floats your boat. But, and actually looking at it as what's the best where is the best place for my capital? How should I allocate my capital so we can grow the fastest? Is that a single family home buying at the top of the market right now? And I'm not saying it's the top of the market, but I'm just saying that the perception of, maybe that doesn't make sense. And so again, like allowing people to rent allows people to live that American dream in those single family
Yeah.
homes. But they're not forced to buy a bank product, get a mortgage, so they don't have to go into hundreds of thousands of dollars in debt to have that
Hmm.
American dream. Who cares if you're paying $2,000 a month to a landlord, or if you're paying $1,200 for a mortgage, but you've got another $1,000, $2,000 in maintenance and upkeep that you're going to be paying a
I
year.
Yeah, I've said a couple times over the past few, upkeep and maintenance. There's a reason why the term homegrownership rings true to me, and it's not maintenance free homeownership.
No,
That's for sure.
it's not. Okay. All right. So just quick, because we're trying to keep these videos like efficient. Okay, Greg. Well, we need to get Greg on the Gray Report. I think we should set that up. We feature his articles quite a bit. Annual change U.S. effective asking rents hits a record 8.3% in July. We are seeing it in our markets. So in the Midwest, especially Indianapolis, we are seeing this for sure. Occupancy sets new all-time high, 96.9% in July. Again, that I'm confirming that anecdotally what we're seeing in our portfolio. Occupancy is very tight. Wow. And big rent growth remains widespread. I would have to agree with that statement. We've seen some just eye-popping rent growth numbers. I mean, Boise, Idaho, which already had record-breaking rent growth. I mean, pricing up 24%. Crazy stuff. We're seeing some similar levels even in some parts in Indianapolis for certain product types. It's crazy. So, and I was just talking to an investor earlier, and you see, so most of this is, it's not that all rents have grown. So I think that we need to clear that up. It's the market rents have grown. So there's a difference between lease rents and market rents. Lease rents are what are people actually paying leases? No, they may have signed those leases a year ago though, or 8 months, in the past year. Market rents is today. What are the street rents? If someone walks into the office, I want a 2-bedroom apartment. What are they being offered by the leasing agent to rent that unit? Now, there may be 0 apartments rented out at that market rate, but that's what they're trying to achieve. It takes time to absorb those new market rents, and that's where it's exciting as an opportunity, because those new market rents are the 6, 9, 12, 15, 20, 24% in Boise, Idaho. That's the gap now between the lease rents and the market rents. And so there's going to be a period of, I think, 1 to 3 years of just these lease rents being absorbed up and renewing to the new market rent levels. And that's where, and that's why we're seeing the cap rates continue to compress, is because all this growth is being priced in. And I think cap rates in the short term are going to decline even further than they are right now, just because of all the growth is going on. And then whether they stabilize or they rise back up to a somewhat normal level. When I say normal, maybe 5%. Their national cap rate right now is 4.75%. It's crazy. It's sub 4 in some markets in Atlanta. I've heard it's sub 4, 3.5 to 4% cap rates. I mean, again, we're talking, and this seems nuts, but then you look at Europe, and Europe has 3 to 4% cap rates also.
Yeah, it is. I think that demand is going to continue. Demand is almost guaranteed. It's. I think what's interesting is the curve that you can see there. It just got, there is no stopping it. I don't see any kind of flattening out of this yet, and it obviously won't go down. I think that low supply is interesting, and there's a couple reports that we're seeing here, but I think the real story is that this demand is just going to increase and increase, and like supply is okay, but it's nowhere near where we need to be.
Yeah, supply is elevated, but and that's a good segue, because we had a really good report from Marcus and Millichat that we featured on the report last week. Basically anticipating 360,000 of units delivered in 2021, 460,000 plus or minus of units of absorption for 2021. So a difference of 100,000 units. But Berkadia released a national report this week, mid-year report as well, and they had some different numbers, and I was trying to scratch my head a little bit, and I don't want to get too into it, because I want to be able to provide more or less an answer. But so they've got 2020 units. They've got 397,000 of units are being delivered, and 335,000 units being absorbed. So that's a difference of 60,000 units plus or minus of that we're going to be oversupplying. But then further on in the report, they're talking about how occupancy is going to get even tighter, which doesn't 100% square with me, and it runs counter to that Marcus & Millichap report, and also kind of what that Real Page report was talking about, although it wasn't specifically getting into supply pipelines. Matt, what were obviously Berkadia, they're a brokerage. They have lending outfit as well.
Yeah.
You would think
So
that Marcus Millichap is as well. But then Real Page, the Yardies, the Co-Stars, they're getting a little bit more data directly. At least Yardi and like the Real Pages of the world. What's your take on this report?
So I'm not asking everyone to be as nerdy as us, but I did group these reports together, and I'm glad that we're talking about these together, because I think it's instructive for people to be able to weigh these different sources of research against each other. It definitely you would benefit from looking at the same reports for the same time period, and kind of figuring out maybe there might be small discrepancies, there might be emphasis that's different. I think that on the whole, though, a significant motivation for providing this information from these companies is to connect the excellent research with an excellent company. I think that there are differences, like I said, in but some reports may have conclusions, insights, or data that others might miss. And it's up to you to really figure out which one you think is maybe more valid for your strategy, your market, and in your kind of view and perspective on the market.
Yeah. And just taking a little bit of a skeptical eye into some of these reports and really kind of putting your own aggregate together, because a lot of these reports are put out by firms that have a interest in seeing prices go up in the market to be good. Now, I've seen them, they lose their credibility if it's all rosy, though. And you'll see in asset classes that aren't doing that well, it's not all rosy. So I don't not trust them, but it's just like anything, having a healthy degree of skepticism, I think is appropriate. So, and
that's what I wanted to really emphasize here, is it's not just one, because there's more than one company that's doing this. There's pressure to be more accurate, and it gives that opportunity for investors and individuals to make their own decisions and figure things out themselves.
Yeah. Okay. It's been a fascinating week, Matt. And unfortunately, the Gray Report newsletter it's so comprehensive, and it's really an impressive piece, and it's really kind of the cornerstone of a lot of the stuff that we put out. So anyone that's watching this video and you're not subscribed to the Gray Report newsletter, I highly recommend it. You're going to benefit from it. Again, unsubscribe if it's not providing any value. But I don't know. I have not been able to find a place. Well, there's only one other place I can think of that has this much information packed into it. So again, when you update you on the market, everything that's going on, multifamily, real estate, and the economy, it's all here in one place. And again, the only place that you can get close to this type of information is just directly going to grayreport.com. Updated throughout the day, 24/7. We're aggregating all of these research reports. We've got this like collection of RSS feeds. We've got virtual assistants. We've got Matt. We've got a whole team that's kind of like just making this just awesome resource. It's completely free. We don't have any ads. The only thing you might see something from us at some point, but I don't think we've got, there's nothing even about, you can join our investment club. Great, do that. Sign up for the newsletter. You should certainly do that. But I mean, you're interested in videos, check out some multifamily videos. We've got a list right here. Again, this gets updated. Podcasts, what are the latest podcasts? Looking for a new podcast? Check it out. There's a list right here. Quick market updates. So hop on over to grayreport.com. Check it out. Let us know what you think in the comments. And if you're not subscribed to our YouTube channel, hop on and do that. That's easy. You're watching YouTube. Click the button right now. Give this video a like, because then that tells us, Matt and I'm like, okay, somebody's appreciating what we're doing. We know they do. We get comments all the time. People email us, give us a call, see them on the street. It's great to see that people are actually using this as a resource, but let us know. It helps other people find this as a resource. Tell your friends. So yeah. All right. This has been another Great episode of the Gray Report. I'm your host, Spencer Gray, again, along with Matt Bosnagel. Have a great rest of your week. Stay up to date, grayreport.com. See you next time.